In advance of the Federal Reserve's monetary policy meeting next week, I'm going to quote Drake and 21 Savage. Federal Reserve, can you do something for me? Like not raise interest rates for absolutely no reason next week. From the ashes rises the phoenix when it comes to Bitcoin. Somehow, Bitcoin is now working as a flight to safety and quality, the same as gold and treasuries. Looks like this week has been a trip down memory lane. We're revisiting some themes from the financial crisis. Words like systemic, too big to fail, moral hazard, and contagion. This is not good. And the housing market, as I want to reiterate from last week, has bottomed as rates have also topped. Welcome back to This Week in Mortgage, everybody. My name is Sam Battagna, your favorite mortgage broker here in California at Mortgage Black in Beverly Hills. Hope you had a great week. All right, what a week. Felt like 2023 at some points and felt like 2008 all over again at others. All right, the Federal Reserve, like I mentioned last week, they broke their toy, and now they may have broken everybody else's toy in that process. Basically, what they're dealing with here is a crisis of confidence. Investors, the economy, everybody has to have confidence that the Federal Reserve actually knows what they're doing and controls things. So right now, this is a basic crisis of confidence. Just like everything else, this too shall pass. Who knows when? Federal Reserve is meeting next week. They're going to raise a quarter, I bet. Bad move. Like I mentioned, it's not the 0.25% that they're going to raise that's going to scare the economy. It's going to be the fact that they're out of touch, that we've got banks failing left and right, and they think it's a good idea to maybe continuing raising rates when we haven't even felt the effects of the last 4 rate hikes. So they really don't need to raise rates. If they do, stock market is not going to like it. But as I mentioned, and what played out this week, the bond market's going to love it because that's the flight and safety to quality. Our compatriots over in Europe yesterday, Christine Lagarde, the reserve chairman, let's call it, of the European Central Bank, she raised rates 50 basis points yesterday over in Europe. I don't think that our Treasury is going to get the same coverage that she got because on that same day, in that same news cycle, a Swiss bank actually bailed out Credit Suisse and saved them. So she had a little bit of coverage because she had a good news, bad news cycle during her news cycle. I don't think our Federal Reserve is going to have that same thing next week. They're not going to get the same coverage as Europe. Don't raise rates. Economic data right now shouldn't matter. I've been saying economic data really doesn't matter for a while now. But right now, considering we have a new crisis on our hands, and it's almost a self-inflicted, self-fulfilling crisis brought on by the Fed raising rates for absolutely no reason for the last year, pretty much. They didn't let the stimulus money work its way out of the economy. So right now, economic data doesn't matter, but it really doesn't matter given the banking crisis that we're in the midst of. Couple quick little notes here. Oil. The hoax that oil is. Oil is now at $65 a barrel. I don't know. 5 months ago it was at $120 a barrel. 3 years ago it was negative $25 a barrel. As I've said before, oil is a hoax. It's a dirty thing. It's not good for our environment. And it's certainly very much manipulated, again, by the oil cartel. That I don't know how cartel can be seen as a positive word. But the oil is the only thing that you can actually buy that on your balance sheet can go from an asset to a burden overnight. That's played itself out. It's an asset if it's trading above zero, but it becomes a burden and you actually have to physically store it when it goes negative, like we saw it do a few years ago. So the hoax of oil is Federal Reserve does not have to worry about oil participating in inflation on a natural basis right now because oil is at $65 a barrel. Almost half the price it was a few months ago. Hopefully we'll see that translated when we go get gas in the next couple weeks. And something else, the volatility index, the VIX. A lot of people like to follow this as a third-party measure of the markets and appetite. VIX is very low right now. Considering what's going on, the volatility index should be higher than this, but the VIX is holding steady. So something else for the Federal Reserve to keep in mind next week. And just some quick advice for the Federal Reserve. Tony Soprano told Ralph Cifaretto on The Sopranos one time over the Ginny Sack joke not to apologize. The reason he told him not to apologize because at that point he's admitting guilt and losing control of the conversation with Johnny Sack over the Ginny Sack joke. The worst thing the Federal Reserve can do at any point now is actually admit guilt because they will lose control and this crisis of confidence we're in will then exasperate itself. So Federal Reserve, don't apologize, just don't raise rates anymore. Moving on to Bitcoin. I think we can actually say the crypto winter is officially over, and from the ashes rises the phoenix. Bitcoin's up like 30% this week. At the same time, people have been fleeing risk on, like stocks and whatnot. They've been buying treasuries, like I mentioned last week. Yields have come down. They've been buying gold, the most natural and historic flight to safety. And now I think Bitcoin has figured out its place in our society over the course of 5 days. So, I said before I didn't understand Bitcoin, but I knew at some point in this planet it would be the hedge of a hedge of a hedge, and here we are. Bitcoin, crypto in general, is now acting like treasuries and gold, which if somebody told you this a week ago, you would think that they were crazy, that Bitcoin, which is actually just an algorithm based on confidence that you can't see, and you really can't even buy groceries with it yet. That's the crazy part. People are choosing to take their money out of banks clearly and putting it into Bitcoin. And I guess when you think back at the origins of Bitcoin, that was the reason it was invented, because people didn't trust the banking system. So it's very interesting that people are buying an algorithm that's based on confidence over putting their money into banks, because then the only way you can see this is Bitcoin's up 30% in the last 5 days. That's a huge move, and it's not talked about enough. So now I believe Bitcoin has found its place in society. It's a hedge of the hedge, just like gold and just like treasuries, but you can't even buy groceries with it yet. That's how much confidence there isn't in our banking system right now. Moving on, looks like 2008 again, some points this week, some of the greatest hits. Moral hazard. We had a moral hazard back in 2008 of bailing banks out that took too many risky plays. Well, moral hazard hasn't been mentioned this week in a serious way because it's morally hazardous to not bail the banks out at this point, let the depositors lose their money, so I'm glad that didn't happen. Too big to fail. Well, guess what? Too big to fail, they keep getting bigger. Somehow, one man gathers with another man spills, and the pieces of these banks that are getting broken up or sold off or whatever they figure out this week, they're just going to be enveloped into the biggest banks in the country, which will become way too big to fail, just like they have been since Dodd-Frank came out, which actually was the intention of Dodd-Frank, is not to make them too big to fail and become systemic. But here we go. Unintended consequences. The bigger banks are going to become bigger. The Federal Reserve actually has a playbook for this. I keep saying they don't have a playbook for this economy, but they have a playbook for taking over banks. Silicon Valley Bank. They shut down Signature Bank this week as well. First Republic Bank looks like it's on the ropes. Funny thing about First Republic, the regulators tried to take it over in 2008 and make Bank of America take on their assets, and they got out of it somehow. Looks like the regulators back in 2008 were correct about First Republic. It was a house of cards, and here's the proof of it today. And there is going to be some new regulation coming out. Hopefully, they make different regulations for different size institutions, because as we know, if compliance gets too heavy, the smaller banks won't be able to compete with the bigger banks, and that, once again, is not the intention of Dodd-Frank. So do not give blanket resolutions to the upcoming regulation that's coming in housing. And this time around, the banks bailed out the banks. This is not systemic. Bunch of banks gave $30 billion to First Republic as a deposit to keep them afloat over the weekend. We'll see what happens. Moving on to housing and mortgages. I told you last week mortgage rates would drop as yields dropped. Yields have dropped much more than mortgage rates because this crisis right now is actually in banking. So, of course, banks are going to be a little shy. But mortgage rates have topped. Housing market has bottomed. Absolutely. And just like every time we come out of a bad time in the economy, bad economy is good for housing. And just like every other time we've been in a recession, you can count on housing leading us right out of it. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, any questions related to your mortgage, please call me. Friday, again, sunny in LA. Thankfully, that's terrific.